Hi, Maverick Millionaires. This is Mitch Levin again. I want to share with you an example of a client that we'd had, and this was an amazing story. So they're a $20 million a year professional service provider, and they were selling off a division, and this division was valued at $5 million to a publicly traded company. So you had this publicly traded company willing to spend $5 million for the company, but they did not want to buy 100%. What they wanted to do was buy 80% of this $5 million company, so which means that they were going to pay $4 million, but they wanted the other 20% to be purchased by the employees of this big company. That way, the publicly traded company can be assured that this division would have some skin in the game and the employees would generate more revenue to make that purchase worthwhile. In the meantime, the founder of the company was going to get his $5 million anyway. How was that going to happen? And wait till I tell you how this all happens, because it's just amazing. So the $4 million was going to go to the seller. Now here's what would have happened to the remaining 20 key employees who were going to buy into this division. They would have to come up with collectively $1 million to then buy the shares from the publicly traded company so that they had their 20% interest in it so that they would continue to grow this particular division. Well, in order to get $1 million to invest in something, you will have had to have earned $1.6 million, pay your $600,000 in tax, and then you'd have $1 million left over to invest. So $1.6 million would then leave you $1 million to buy. But here's what the seller was going to get. The seller was going to get that $1 million, and then the seller is going to have to pay capital gains tax of about $250,000. So $1.6 million becomes $750,000 with the stroke of a pen. Here's what we did. We said that what we're going to do is take that $1 million and it's going to be earned by the remaining employees over a 6-year period of time. So instead of the employees having to pay cash, they were earning it over time. So they would get some sweat equity in the deal. In the meantime, the publicly traded company and the employees were going to then pay to the seller about $160,000 a year for 6 years. That's about $1 million. So now the seller was going to get his $1 million over the 6-year period of time, which is at least as much as he was hoping to get before, and that would be deductible to the new employees, so they would pay 0 in tax and 0 in cash. The seller got all his money, the publicly traded company got the business that they were looking for, and the employees got their portion of the business with a tax-deductible approach, which then netted them out about $50,000 to $75,000 a year in additional income that they then could split. I promise you that the accountants for all the parties, the attorneys for all the parties, the boards of directors for all the parties did not come up with this structure. Your Maverick Millionaire came up with the structure. That's why they call me the financial physician. This is what I do. This is how I structure things. Everything's bright line legal. All of the attorneys and the accountants and structural people involved had this V8 moment. They slapped themselves in the forehead and they said, I wish I had thought of that. Well, that's how it works. This is what we can do for you. This is the kind of thing you could do whether it's on a large scale like that or on a much smaller scale, because we have key employees that we've got to incentivize and keep involved in the business. Otherwise, we're just not going to be that happy with it. So make some really great decisions. Get the ultimate business growth, money, and time machine. Join the Maverick Millionaire coaching group. Just fall in love with your business again. You're going to be amazed. Let's help make your business great again.